Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. I'm James Enriquez.
I'm James Credo.
I'm Alexis Villarreal.
And I'm Leo Chang.
And today you asked and you shall receive, because we're going to talk about withdrawal strategies. Believe it or not, we had a viewer request on the topic. So first of all, I would like to acknowledge that we may look a little bit different. Well, that's because, some of us may look a little bit different because some of us are participating in a team event. James, how's your participation coming along?
It's been tough. I've been wanting to shave it. It's been 3 weeks, but I'm a team player.
Dude, the discipline
I'm gonna
is
keep it.
uncanny.
I'm going to keep it.
Yeah.
Yeah.
Is it getting pretty itchy? Is it tough to manage now?
Yeah. I can't recognize myself, so. You guys look the same.
That's probably for different reasons.
Not the same ones that we're thinking of.
Oh, okay.
Is your wife noticing anything different from you?
Yeah,
Acting
she
different?
told me, who is this man?
Who is this guy?
Who did I marry?
You definitely look a lot different.
Thank you.
Yeah, so withdrawal strategies.
Yes.
Okay, so I want to clarify a couple things before we get started, because oftentimes when we hear withdrawal strategies, where does your mind immediately go? Who does it pertain to?
Retirees.
And this is not going to be just a retiree withdrawal strategy. Yes, that's what it typically applies to, but think about scenarios such as getting a big settlement from a lawsuit, or exiting a company early and being a serial entrepreneur but wanting to spend down some of your assets, or getting a gift or an inheritance. Like, yeah, that's set aside for retirement, but wouldn't it be nice if I could spend just a tad bit now while I'm young and have some fun?
Yeah. That
How
nice
dare you.
watch that I've been eyeing for a couple years now. Maybe you can dabble into that purchase.
Well, I was speaking with the proverbial.
Oh, okay.
Wouldn't it be nice if I could?
Oh, yeah.
Yeah,
Yes.
proverbial.
Wouldn't it be nice?
But yeah. So when somebody asks you that, how do you answer it? Or you know what? The question typically comes in the form of, "Hey James, how much can I afford to spend without running out of money?" Do y'all get those kinds of questions? And if so, how do you answer it?
I hardly get those questions, by the way. I feel like one of the weird topics, I feel like when you get that conversation with somebody, it's more of trying to figure out what and how much they need. You start going through this question process with them, in this leading up into this, right? Started looking at some of the different things. We had some very funny names being thrown out there. What was the one that you used earlier?
Are you talking about the Guyton Klinger?
There you go.
Okay.
Guyton Klinger.
Yeah, we'll get into that.
Yeah.
But okay, so I like where you're going with that, but I don't know. Maybe you don't hear this, but I hear this a lot.
Yeah.
I don't know how much I'm going to need.
Yeah. I think most clients, when they're asking that question, they're kind of sharing with you that I want to be able to take out money, but make sure I don't run out of money. And that's what they're really asking for. And so there's different ways to go about it. And, there's rules of thumb, like the safe withdrawal rate, just to make it very simple for clients. That's a starting point that I like to use with them, which is approximately 4% is what you can withdraw from your portfolio, assuming that you're investing at least half of your money into stocks and into bonds, and that account can still last for at least 30 years. That safe withdrawal rate actually came from a financial advisor back in the 90s. His clients were asking him the same question. Hey, how much can I take out from my portfolio during retirement and make sure that it'll last at least 30 years? So he did a study, and he published it on the Journal of Financial Planning that looked at 30-year time frames, and he looked at specific periods in the marketplace where the stock market was taking a shellacking. So he looked at actually the Great Depression. If you retired during the Great Depression and you invested your money 50% stocks, 50% bonds, and you would take a specific distribution rate but increase that by 3% for inflation, will that pot of money last? And he found in most situations it would last at least 30 years. So that's what we use as a starting point for the conversation. And it's an easy conversation. You know, if you got this amount of money, you take out 4%, and that will last at least 30 years. And then that's where you can make adjustments based on the client-specific needs.
Yeah.
Yeah.
So for all you Googlers out there, the name of the person that came out with that study is William Benjamin.
Yeah.
That was back in, I think, 1994.
Yeah.
So 30 years later. So now we have a new 30-year time period. And, well, I think what some people found is that, hey, I have a lot of money still built up. I haven't spent it all down. And so he actually adjusted it up from 4 to 4.7%.
Yeah.
And getting to the Guyton Klinger that you mentioned, they came up with a higher withdrawal rate because they found the same problem. Yeah. So,
But I think that's a good starting point, like you said, right? To where it just kind of gives people, when they just come to you just out of whim, right, from all different angles, right? Like that's like a good starting point for them to at least kind of give a baseline. And then from there, right, you start digging into some different options for them, right? But that at least gives them a number that they can kind of work off. Can I live off of this, or do I need to do something different?
I think it's good. I think it's a good starting point, especially for individuals like we had mentioned earlier, right? This isn't just a strategy, or this isn't just a situation for retirees. You know, an individual inherits, you know, they run into a windfall, they inherit a certain amount of money, and they're in a situation where they probably didn't have this substantial money where, you know, from their perspective mentally, the concern is, man, I could run out, right? I could spend this down. This could be gone, you know? So what do I have to do to make sure that this doesn't happen where I just run out of money? And so these very conservative type of strategies, distribution-wise, are that they're super conservative, but it's an idea to help them feel comfortable saying, hey, if we follow this plan and this map, you really won't run out of money. It'll be there, and more than likely you'll have a substantial amount of this left at the end of it. But in these circumstances where you have a business owner that just sold, they're in their mid 30s, you know, early 40s, they have years to go. So their primary concern is, man, I didn't have this money before. I had an illiquid asset, and now I have this cash, and now I have this inheritance. You know, how do I figure out the best way to utilize this but it doesn't just vanish in thin air? You know?
so what do you do in those situations? Is 4% still appropriate in those specific situations you just mentioned?
4% is going to be appropriate, I think, in almost any scenario if the idea is to never run out of money. But you know, the way we spend is so different, right? We could be spending more today than we may need to be spending next year. It goes back to a lot of our financial planning conversations that we've had. And in those discussions, understanding ideally what the client is looking for. Are you looking to completely pay for your entire lifestyle with this money? Are you looking to utilize it to supplement income for a short period of time? Are you looking to, you know, utilize this, you know, to pay for a specific investment that maybe you're doing it over a specific term? I think the conversation has a dependence on what the client's need is and how long that need's going to last.
Yeah, I almost feel like that 4% thing works for someone who's like ultra conservative, who knows exactly what their expenses are. They're very modest in their lifestyle. They almost have. They don't really want wiggle room. They want something super simplistic, something that they don't want to have to really be engaged in. And I feel like most of the people that we work with, they're looking for other things, right? They're looking to be creative in regards to how to move the money around and how to be able to be efficient, whether it be tax-wise, whether it be distribution timeframes, or, you know, and so, you know, that it's a good, I think, easy starting point, but, you know, I think as you start digging deeper with people, you start going into different dynamics to really try to maximize whatever benefits they're after. Right. So,
like with Benjamin's analysis, that he found that the majority of his clients would actually end up with a sizable balance, if not the original in principle. But I think most people, you can show them all these analyses, but you don't know what tomorrow brings. So even when you say he looked at the rate of return starting from the Great Depression, I think when your time frame is longer than 30 years, I think you have to even use a more conservative rate. Like someone like getting a settlement, an inheritance, a gift in their 30s and 40s. Now you're looking at a 50-year time frame, and I think that's where you have to go start with a lower withdrawal rate below 4%, because you're making for adjustments over time because of life, and you don't know what those will be. So I think you do have to start a little bit lower, and and there could be the risk of sequence of returns too, something you have to consider, along with other factors that Alexis mentioned. So
What is sequence of returns?
when Benjamin was looking at these rate of returns, he found that there are several things actually that can make a portfolio not last as long. And he was actually kind of surprised to see that one of the risks was actually being too conservative. Okay, meaning you don't have enough of your money into stocks. Okay, he also found that another reason why your portfolio won't last as long is because of higher periods of inflation. Because he made an analysis using a 3% inflation rate, but in periods of higher inflation, that's really detrimental to a portfolio. And then what he also found was that in your early years of your retirement, when you're taking withdrawals and then the stock market is also down, that's also a big problem to your portfolio. So as much as possible, you have to have strategies in place where if the market does go down in your first few years during retirement or when you're taking withdrawals, that you're not taking from the portion of your portfolio or investments that's down.
I think they call that the bucket strategy, right?
So, yeah.
Yeah, you know what? I probably should back up. So when people ask me that direct question, I like to try to give them a direct answer.
Right.
The direct answer is the one I usually give is 4% general rule of thumb. It'll allow you to give it'll give you a 3% cost of living adjustment every year for about 30 years.
Yep.
But we should take a look at your specific situation.
Yep.
Back to your point about expenses. Let's put it into the software. Let's see what the software says. But I understand you might not know those things right now. And I don't know about you guys, but I'll get that question from people of all different life stages,
Right.
including people our age, right? How much do I need? So the question's
Change a little bit.
it's formatted a little bit
Yeah.
differently. It's formatted more like how much do I need to have saved up?
Right.
So I'll use that 4% rule of thumb
Yeah.
to work backwards. Okay. So for example, easy math. If you know that you want $40,000 a year off of your savings, then you're going to need $1 million saved up and then just work backwards from there.
Yeah.
I'm 40 years old. I want to retire at 65, 25 years of savings, 7% rate of return, for example. How much do I need to save every month? So work backwards.
Yeah.
So that's the way I would answer that.
Yeah.
Okay. But there's so many different ways to actually manage that withdrawal. There's the 4% rule. There's the Guyton Klinger that we mentioned. And you also mentioned bucket strategy.
Right.
What is the bucket strategy?
I feel like that's the one that is we mostly utilize, especially if people are starting their distribution phases, they're starting their retirement life. It's essentially putting aside their short-term needs in some sort of liquid asset, money market account, laddered CDs, and we can do that anywhere from 12 to 24 months, dependent on their own risk tolerance, right? How flexible or how bendable they are in regards to their their needs for their retirement assets. And then we typically have some sort of next bucket, which is their midterm, 3 to 5 years, 6 years out, something to where it's giving us some sort of yield, a little bit less risk, and then something a little bit further down the road. And I feel like as I use this strategy most often with clients, we start doing through the software, looking at their retirement goals, and right, we normally see a surplus, and that's where we start getting into, I think, some different conversations into figuring out tax advantages and things like that. So.
Yeah. Would you say would you say the bucketing strategy is more of a behavioral thing more than
I definitely think it puts people at ease, right? Because I think there's some negatives about it too, right? There's some comments about lack of returns on some of those assets that we've earmarked for, our shorter term needs. But at the same time, I think it's a lot easier to talk to clients about this, have them understand what that process is going to be. So when we do have volatility in the market, they're not as emotional about it. They already kind of know we have a plan in place. And I think that kind of helps them be at ease with taking on risk in the longer term assets.
So,
Yeah.
so what do you tell them when they bring up that concern? That's questions for anybody. Because I know what I say.
Well, I, in that process, I make them fully aware of the fact that we have a very, very conservative vehicle that we're utilizing for that term. So, whenever we look at the distribution plan, having them have a clear understanding that whatever we have from a need base for the next couple of years, say 2 years, it's in something that has little or to no correlation with equity markets. So whenever they do see, 2022, for example, we're in something so conservative that even though every asset class is dealing with what we were dealing with in 2022, we have such a low risk investment for them that we can still continue to provide the distributions that they depend on during that time frame. And then you go through that 2-year period of time, and that should be, in most circumstances, plenty of time to allow markets to recover, and then their sentiment completely changes. And that's literally what happened over the past 2 years, where you had one sentiment at that point in time where individuals were concerned with their distributions and giving them a level of comfort of, hey, that's in cash. That's in an insured bank deposit that we send out to you every single month. We have 2 years worth of money in that for you. So, we have a 2-year time frame to allow equity markets to recover. And at that point in time, then we can replenish that liquid asset for you. And that provides a different, overall emotional, feeling for them, knowing that they don't have to depend on a performance within equities to be able to continue to get the money they need to pay, their insurance or, whatever their lifestyle is, whatever their needs are.
Yeah. Have you ever heard the saying, you can't have your cake and eat it too?
Yeah.
Well,
Guess
definitely
what?
once
This
in a
time,
while.
but guess
This
what?
time,
This
yeah.
time you can. So, have y'all seen that study that shows the bucketing strategy versus an asset allocation strategy, that the difference in returns is negligible? So this is to that point that you're saying that clients feel like they're sacrificing return for safety. So let's use that example. By the way, this is not advice. You have to talk to your advisor and look at your personal situation. But going back to that $1 million example, $40,000 income that we want. So let's say based on my risk tolerance, my goals, and my time horizon, I want a 60-40 portfolio, stocks to bonds. So I want to keep $600,000 in stock funds, not necessarily individual stocks, but $600,000. $40,000, my distribution will be in something safe, like FDIC insured cash. I'll take another $40,000 and put a 1-year CD. So now I know I have 2 years worth of distributions safe from the fluctuations of the market.
Right.
But that's going to come out of my fixed income portion, out of the $400,000. So I'm still getting full equity exposure.
Right.
And to your point, like a year like 2022, where bonds were down too,
Yeah.
even those 2 years of income are
So
safe.
good.
So I think you might be able to have your cake and eat it too, have that safety without sacrificing returns. Do y'all, what do y'all think about that?
Yeah, it's always like a give and take. That's why we always like to say, as long as you can reach your goals, you can take as little risk as you want or as much risk as you want. Because at the end of the day, the more you have in safe money, you will feel better, but you might have less money in the long run versus taking on more risk. But it's going to be able to help you sleep better, transition into retirement, because if the markets are going down, you have safe money. But long term, you probably won't make as much money. So it's always a give and take. But as long as you can reach your goals, it's fine.
I feel like this generation of retirees that we deal with at this point in time are from an era that are used to saving. And so they're not used to spending. And so even as you go through a lot of these strategies, it's hard for them to, a lot of them have leftover. They're going to have leftover just because of their saving habit nature. And so, you can have all these different withdrawal strategies. Some of them you get in some, I guess, unique circumstances where you don't have a big need for it. Right. but yet at some point they're going to have to start taking withdrawals. So right, so then you even have some forced withdrawals in regards to RMDs. So you start looking at some different options for them. And I don't know, I feel blessed to have a couple of these recent ones where, hey, you need to start spending. You need to start figuring out what to do with it, right? And so I think going through, different options for them, right? It's like there's a lot of different ways to go about this.
So that's why I like the Guyton Klinger, because it's meant to address the fact that you might end up
With more.
passing along a large amount.
Yeah.
So, what are your thoughts on Guyton Klinger, and how is that utilized?
I like the idea of it. I just don't like the practice of it. Because I've seen it modified by practitioners that actually use it, and quite frankly, at least with our clients,
What is Guyton Klinger, and then
Yeah. So there's different withdrawal strategies, and we mentioned earlier that Benjamin realized with his strategy that most people are ending up with a sizable balance at retirement. So there's other strategies out there like this one where we're trying to, where you can draw a higher rate over time, and hopefully you won't have as big of a balance after retirement. And so with this strategy, you would reward yourself by increasing your withdrawal rate when your investments are up, and then you would make an adjustment. If your investments are down, you would actually reduce your withdrawal rate, but over time, you would be taking a higher withdrawal rate compared to the safe withdrawal rate as mentioned by Benjamin.
Yeah.
So,
That's probably, I feel like that would pertain to more individuals that have this flexibility, right? So individuals that we were pertaining to, not necessarily just retirees,
right.
but individuals that are in circumstances where you do exit a business early, and you're utilizing capital for other investment opportunities, you're utilizing it for living in needs, but figuring out and being able to be dynamic and looking at strategies like Guyton Klinger to be able to provide a solution for these different times of need and how that fluctuates because of the time in your life and when you have this asset and how you're going to spend it. That flexibility is unique, but it also can be able to help individuals really, stretch out those assets over a longer
I
period
think
of
that
time.
kind of goes with just behavioral aspect of it, right? There's so many factors in with regards to withdrawal strategies, right? Life expectancy, circumstances, family dynamics, second marriages, kids, no kids, and so you start going through all these different nuances with them. And so sometimes, I think most people want to come in and make sure they have enough to live off of. And then the second thing they want to figure out is how to take it out without paying as much taxes. I feel like that's what we deal with the most.
Yeah. So what's funny is I think about it the other way, what you just said. I think about if in situations where you have a windfall early, you actually want to use the initial withdrawal rate, safe withdrawal rate,
Conservative one.
and not give yourself a pay raise, because you might need that money later when the paycheck stops.
Yeah.
Because for you analytical people out there, so the way that works, to what James was saying, the Guyton Klinger, is let's say you take a 5% withdrawal rate. Quick side note, I think they determined the initial safe withdrawal rate of being about 5.6%.
It's like a range of 5.2, 5.6.
Yeah.
Yeah.
Which is higher than
Higher than
even
safe.
than
Almost-
Benjamin's revised one.
Almost a
Or
full
higher,
percent.
yeah.
Yeah, almost
Yeah.
100 basis points.
Yeah.
Yeah.
So for those of you that want to spend down more, you might want to use that one to justify it. But anyway, so easy math. Let's say 5%. So let's say you determine your initial withdrawal rate is 5%, and you're using the Guyton Klinger or guardrails or dynamic. It's called many different things. But so let's say you start with a 5% withdrawal rate, and your portfolio value increases to where your withdrawal rate falls. If it falls by more than 20%, so in other words, if you're down to a 4% withdrawal rate, you increase the dollar amount that you're taking by 10%, and vice versa.
Yeah.
So if the portfolio value drops to where now your withdrawal rate is 6%, you're reducing the amount that you take by 10%. So I hear what you're saying, but if I have to like adjust my spending by 10%, is that the worst case scenario?
Yeah.
And again, I'm using the proverbial I'm trying to put myself in your shoes,
Right.
but thanks guys for
I
calling
think
me out.
in those situations too, it depends on the reliance as well.
Ooh, reliance rate. Is
Right.
that what you're talking about, reliance rate?
So-
let's hear, okay. Come on with it. Come on with it. What's
So
the
in this, well, in those circumstances, right? Because we utilize that.
No, I mean,
when it comes,
tell people what the reliance rate
So-
is and then tell
sure. So the reliance rate is a measurement we utilize to determine how much of your personal assets you depend on for your income. So with retirees, a lot of retirees have multiple different sources of income, right? You have, in most circumstances, Social Security, in some circumstances, pension, and also some type of annuity that may be paying you fixed payments really for the rest of your life. And so what we look at is the gap between what those sources of income provide and what your spending need is. And whatever that gap is, how much of that do you rely on your personal assets to take care of that income gap? And whatever that percentage is, that's your reliance rate. So what I was referencing earlier was that I guess it may depend on what the reliance rate is when you're looking at that percentage need, because if that 10% adjustment has no bearing on your reliance rate really, then depending on what the total amount is, then it may be appropriate.
Yeah. Am I taking one trip to Tahiti or two?
Right,
Is that-
exactly,
yeah,
exactly.
yeah,
Literally
yeah,
exactly what I mean.
yeah. Just to put it in perspective.
So it just, like I said, it really just depends on the individual situation. But both the dynamic one is interesting because it is something that's practiced a little bit. It's a newer practice style that people are implementing as well too, and it'll be interesting to see kind of how it plays out.
I kind of find myself, I don't want to say I talk about it, but meaning I'm because first 10 years of my career was low inflation rates, and so for the most part, most clients were using the safe withdrawal rate or even less. In the last 2 or 3 years, I find more clients calling about, hey James, if I increase my withdrawal rate, which is above the safe withdrawal rate, am I still going to be cool? And I actually like the question because for a long time I haven't really received that kind of question in terms of like really increasing it. And now I actually get to talk to them about, what is the safe withdrawal rate? Why were we using that to begin
In
with?
the first place, yeah.
Right. And now why am I saying for you specifically, it's okay if we increase it, and then you could go to other withdrawal rate studies, that shows you can actually take a higher rate when you're close, when you're at retirement already. So you're kind of already doing it, but it's not so much that specifically, So
It's funny that you bring that up because you made a comment earlier about theory and practice, which I want to talk about a little bit more later.
yes.
But we talk about these withdrawal rates. We know it. We know that there's a cost of living adjustment in there.
Yes.
I don't think I've ever really like automated a cost of living adjustment for anybody, and nobody's ever really. I've had a couple of scenarios where
Yeah.
some people have asked,
Yeah.
but apparently you're getting asked that and you're doing it.
Yeah, but it's not like systematic like the way the study is, that you're supposed to do it annually or at least
No.
quarterly. This is more of just you're having your meeting with your clients. James, I'm feeling the pinch. Things are going up in prices. If I increase my withdrawals to this amount, am I going to be good? So and
Yeah,
then
we
you're-
haven't increased your withdrawals in 19 years. We should be good
so
the same amount.
and so you're having to talk about these different strategies, and it's what I'm saying is it's comforting to clients to actually know, oh wow, okay, I didn't know that I can actually take a high withdrawal rate and I'll still be okay. So it's still a case by case scenario, but yeah.
It's funny because I get clients that come back to me and like, I didn't know that I could change like how much I could take out, and like they automatically
I could take out more? What?
Yeah, they automatically attribute the distribution process as an annuity or like Social Security, where it's like as soon as I start this, it automatically comes out. It's the same amount. It doesn't change.
Right.
And I have to reiterate to them, like, no, like, we can start, stop, increase, decrease. Like, this is fluid as far as how this process looks.
Yeah, you bring up an interesting point. Okay, so we probably should put that out there. If you use the safe initial withdrawal rate of 4%, doesn't mean you have to take 4%.
Yes.
Right? You can take less. You could turn it off whenever you want. You
Yeah.
can take more.
Can average 4%.
Right.
Right.
Yeah.
Yeah.
And I would argue, I'm sure y'all have come across this, where you're sending somebody the 4%, and then at the end of the year, they ask you, hey, I got all this money in the bank. It's not paying me anything. Can I invest it?
Yeah, like, why are you taking money
Right,
out?
right. Why were you taking money out? You don't need to take money out. It's taxable. If it's coming out of your IRA, it's
I
taxable.
literally
to
had
you.
that question yesterday. Client goes, man, newly retired, man, I'd like to have a little bit of extra spending money, monthly. Would it be okay to take out, maybe $1,000 a month? Good client. And I was like, yeah, it shouldn't be an issue. 15 minutes later, husband's like, well, we got some extra money in the savings account that we're looking to do something with. And I'm just like, wait, isn't your wife? Did we just have a conversation literally 10 minutes ago? Your wife wants extra money per month, but then you want to take out cash.
She doesn't know
that you
about that
have.
one. She doesn't know about that account.
I'm like, this is. Do you guys?
How's the
understand,
marriage,
like, what
by the
you're-
way?
Happy. She's
Happy?
getting.
Okay.
She's getting the $1,000.
It's
She
funny.
won.
Well, it's funny. It's funny how he brings this up though, because I feel like something as simple as that, like you look at it, you're thinking, well, that doesn't make any sense, right? I had somebody ask me a question one time, and they were talking about taking money from an IRA account, and I looked at them and I'm like, I knew that they weren't 59 and a half, and I started asking them, why are you taking it from there? They said, oh, it's because I want to spend it. And I'd already kind of knew that they had some other places where they'd take the money from, where they wouldn't be dealing with the taxes and penalties. So I think educating people from just where to pull the money from and when to pull the money from is part of the process that we try to help them on. Because
I can't. Not that money.
Yeah,
I'm not
yeah.
taking this bucket of money. I'm not spending.
it's funny.
But let's
It goes
take
back
it
to the
out.
behavioral finance aspect. So.
Then let's tease another episode. You just talked about mental accounting, which is a bias, or we'll have another episode on all the biases that hold us back.
Oh, that's a good one. Actually.
Oh yeah, you
Yeah.
bet.
Is that
better
another?
believe-
Is that another viewer request?
Yeah, I'm a viewer.
He's the only viewer right now.
Stop it.
Stop it.
We got some from SMS.
Like, subscribe, share.
I feel like you've been talking about taxes a lot. This
likes
withdrawal. Yeah, can you elaborate a little bit? Yeah. Come on.
Your heart pumping a little.
No, I'm actually I'm curious. I'm wondering
Stop.
what's this guy talking about?
Oh, okay.
I have this guy in my office that will give us some little tidbits from time to time in regards to different impacts that are going on in regards to taxes, changes that are coming about. And so I think going back to different strategies, right? As tax laws change, we as advisors, even though we are not tax professionals, we always want you to seek your professional in regard to any choices that you make. I think it's up to us to also be able to at least be informed as far as how this is going to impact them tax-wise, and if it's better to do certain things within, whether talking about Roth conversions, right? So right now tax rates are low, and so if somebody doesn't have a need, has some extra income, there's some different strategies, right, where we could potentially pay today's tax rates and avoid, what I think is going to happen, right? Tax rates are going to go up. So when they take their withdrawals later, right, they might not be receiving as much. And so these are all just little benefits, right? Our job is to make you money, save you money, protect you, right? And so figuring out these little nuances.
Actually, he just reminded me of something. I think Benjamin's analysis, it was based on taking money from a qualified, IRA or 401k account, and your withdrawal rate would actually be higher if you were taking it out from a non-IRA account. So that's kind of interesting. Where
Which makes sense.
taxes do matter.
Oh, yeah.
Yeah. So.
They matter so much. I want to talk about the age banding principle. Another way to say it is retirement can be broken up into the go-go years, the first 10 years,
Slow go.
the slow go, the next 10 years, and then unfortunately the no-go.
just
What's the third 10 years?
Yeah.
an analytical way to do it is there's this guy that did this age banding study, and what he found is that most retirees change the way they spend their money about once every 10 years, and retirement is broken up into 3 10-year periods.
Right.
And he found from the Bureau of Labor Statistics, there's 4 major expense categories: healthcare, leisure, basic living, and taxes.
Yeah.
To get back to the taxes.
Yep.
And what he found, as I mentioned, your spending changes about every 10 years. So for example, go years, you spend more on
Traveling.
Leisure.
on leisure your first 10 years, and then that drops, but your healthcare expenses go up. Furthermore, he found that those expense categories, they inflate differently. So healthcare inflates more rapidly than basic living.
Right.
Leisure, basic living.
Right.
And so what he found is if you take this approach
Yeah.
for retirement planning, it might reduce the amount you have to save, because what he says to do is to put 100% of your portfolio in stocks, because that gives you the best chance for returns. And then about 5 years before you're going to need money, you put it in something safe like bonds, what you're going to need for that 10-year period. So I thought that was interesting.
Yeah, I like that. Once again, I like the analysis because he assigned a different inflation rate for each of those spending categories. And I think with taxes, the rate starts to go down as you get closer to the no-go years. And then the inflation rate for healthcare will start to increase as you get closer to the no-go years. So I love the study because as a practitioner, it just gives you insight, what your clients are going to experience during their 3-decade retirement years. But in practice, I think most clients, if not all, they just want to know, how much can I take out from my portfolio, and I'll make sure I'll cover all of these expenses. But at least as a practitioner, you know what to expect in the future for your clients and be ready for it. So
Yeah, I feel like they always have an idea right now. I feel like it's up to us to tell them, like, well, yeah, there's always a better way of doing it, though, right? And then going back to in theory and practice, right? We have them do a lot of things, and we figure out things that getting them to do them all, though, right? That's the practice, or that's the part that, right? We got to do a little better.
I think we have a saying. It's actually, I think, Enriquez's saying. Like, we like to ask our clients, do you want to know what time is it, or do you want to know how the watch works? So, and it just depends, for every client. Everyone's different. So,
Yeah. Good deal, guys.
Awesome.
Appreciate
Awesome,
y'all.
awesome.
yeah.
Yeah.
A lot of ways to take the money out. Like I said, go spend. Someone's going to do
A
it.
ton of ways to put the money in too.
Oh my God.
On that note, thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along, and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.